Well, good afternoon and welcome, and thanks for joining us today for our new knowledge session. My name is Sandy Ratliff. I am with Virginia Community Capital, and we are happy to partner with the Washington County Chamber of Commerce, the Virginia Highlands Small Business Incubator, and the town of Abington to offer this series of professional development workshops to new and existing businesses. If this is your first time, welcome. This is a series we started in 2014 to support our Washington County Business Challenge, and it's become one of the longest running professional development workshops within the Commonwealth. Now, before we get started and I introduce our presenter, I wanted to let you know that in order to keep the webinar flowing and to stay within our 1 hour time frame, we have muted everyone. However, we do want to hear from you. And if you have a question for our presenter today, we ask that you post that in the Q&A section, and we will address those at the end of the session. I am pleased to have Mark Tipton. He's the financial advisor with Edward D. Jones and Company, and he will be providing a market and economic update. Mark will also discuss some of the current conditions, give us an outlook for the remainder of the year, and provide some simple considerations for individuals going forward. So Mark, I will turn it over to you, and thanks again for joining us.
You're welcome, Sandy, and thanks for having me. Thanks to everybody who is logged in already. Brittany, Jean, Ron, Sarah, and then I also noticed one of my cohorts, Rita Cascaden, is on as well. So Rita, although you're muted there, if you've got some things you want to add, your perspective in here, please put them in the Q&A or the chat there, and welcome to Anita as well. But this this topic is one that everybody's interested in, but I don't know if you're interested in listening to it for an hour, right? Economics and the market. So we're going to try to, we're going to show you a lot of numbers and try to really just focus on a few important things. Of course, my video screen will be small up in the corner while we're going through some things. But if you want me to stop, I know that we're going to do Q&A at the end, but if you think it's important enough for me to slow down and maybe go back a chart or revisit something, feel free to do that. Again, this is kind of a free-flowing type of presentation, although it is a little odd just talking to a screen and not hearing any feedback. But again, I appreciate you all. And Sandy, thanks for the introduction there. Just a little bit about myself. I am with Edward Jones. I'm at Exit 5 here in Bristol, right beside the VA clinic, across from Sheets, not too far from Rita's office. She's at Exit 7. And this is the type of information that if you have a financial advisor, you may not be talking about all this with them, and that's normal. This type of presentation is usually one that we would give to only interested parties, and it's not part of your financial discussion with your advisor. But at the end of this, we'll probably talk about a couple of things that might be very familiar to you, things that you do talk to them about. And I'm just writing down everyone's name as they come in, just so I know who was here. We have to produce an attendee report. But as Sandy said, obviously face-to-face is the way to build relationships and to share information. But as aggravated as we all are at this COVID scenario, this has been really a blessing in disguise so that we use forms of communication like this. I just got done teaching a College for Older Adults class, the COA. Some of you might be a part of that, up at the Higher Ed Center. And, we had about 26 people on there this morning. And I started thinking that I know a lot of those folks. And I know that if this scenario had not played out the way it has, there was zero chance they would have ever gotten on a Zoom call and taught themselves to learn in the way that they're learning. So yeah, there's a lot of positives out there. There are just so many positives out there in the world right now, but you're not seeing those, right? I want to just quickly take a look at the front page of the Wall Street Journal this morning. And please bear with me as I share things. I'm going to have to go back and change what I'm sharing each time, just the way the system is. And then Sandy, if you could just nod your head, do you see the Wall Street Journal there? Just make sure we've got it.
Yes, it's there.
All right. And when we talk about the markets and the economy, where we've been, where we're going, just about everything in this newspaper plays some part. And I think the reason it plays a part is it affects the way that we think. It affects the way that we act, sometimes in a positive way, sometimes in a negative way. And then sometimes you look at some news headlines and you think, well, that should have an impact on the market, and it's not. Or it's very obvious. Well, this jobs number came out, and although I think things are great here in Southwest Virginia or Northeast Tennessee, why is the market freaking out over this? And then you realize 2 days later that it was just a temporary condition. But what we're going to try to do is just, put together the most important parts of this. But there's no way we can cover everything that is going to affect the markets, the economy, your investment portfolio, whatever it may be. But here's an interesting one. When you look at today's front page, and if you go online, it'll look different. This is the actual print. We've got the Gulf states, Bahrain and the UAE, signing a peace deal there with Israel at the White House. That's the top. Is that going to really affect the markets? Probably not too much. Growing retail sales, China's recovery. Yes, we're going to talk about that. That's going to have an impact. We know it will. Antitrust down here against Facebook. Over here, U.S. Universal drops tariffs on Canada aluminum. The Trump Fed nominee, likes to vote, whatever it may be. But right here, right in the middle, something that is going to be very relevant to what we're talking about today. And it's the fastest recoveries in the S&P 500 from a bear market, okay, from record high to a new record. And you can see right here where we are today, 26 trading days, okay, from February in the fall, well, I should say when it fell, through August, it was 126 days for it to recover, okay? 310 days in the 60s, 434 in the 60s, 87, 89, 485. And there are a lot more here. They just couldn't put them all on one chart. So that was a very, very short and abrupt timeline that the market was tumbling. You'll hear all these terms. When you look at a headline in an article, you may see market tumbles, market plummets, market skyrockets, whatever it may be. Those are just headlines. They're there to get your attention. They're very rarely accurate. So look at the numbers. I think the numbers are important in those regards. But you can see, is this the V-shaped recovery that they were looking for? No, this is the market, not exactly the economy. And we'll talk more about that. Okay. So let me go on to the presentation. And while I'm finding that, I've got a lot of screens open here. While I'm finding that particular presentation, and you should be able to see it now, Outlooks and Opportunities. This is an Edward Jones approved presentation, but it's updated at the end of every quarter. So unfortunately, we're here on September 16th. At the end of September, this is going to get an update, but we don't have that yet. So what I'm going to do is weave in the JP Morgan Guide to the Markets. And that's where all the real heavy, nerdy data is, if you will. And we're just going to use these two to complement one another. The Edward Jones presentation, if you've ever seen one before, more high level. And the JP Morgan one is something that, again, you may never see. But I think both of these are going to be posted so you can look at those at your leisure afterward if you have questions. Or you could ask Rita or myself. Rita has the same material that I do. Okay. So when you talk about the market and the economy, really is, the analogy they like to draw here with this presentation is that it's like a puzzle. It's like a jigsaw puzzle. You get all these pieces and they're all over the floor. And you're trying to put them together to see what the picture is so that you know where the holes in the information may be. But I would tell you, I think that analogy is not perfect because it never fits together the same way. You have endless correlations in the economy and the market, but very rarely do you have a cause and effect. And what I mean by that is any headline you may see, or, we'll even get into the election. People are talking about the election. If so-and-so wins, then this will happen. Well, there's a correlation for sure. There's no doubt about that. But it's not a cause and effect. And I would challenge you to find a very real persistent cause and effect between the economy and the markets. A lot of correlations, but no real causes. But we're going to try to put the puzzle together here for you, okay, if I can just get it to scroll correctly. And really, we're going to start with COVID-19, okay? How has it impacted the economy? Now, obviously, we know it has. Everybody has seen stores close. You've seen people get laid off. If you work at Home Depot like my wife does, it is a completely different story for them than it has been for many other industries, okay? But we came into 2020 off a very good year in 2019. And all the projections that we had in 2019 of what was to come in 2020, if you had to summarize it, you would probably say that, you know, it's the second longest bull market in history, okay, that ended. And when we talk about bull and bear markets, you could consider it this way. A bull market is steadily increasing prices in the market, okay? So the indexes are going up, the S&P 500, the Dow, whatever it may be. And a bear market is decreasing, okay? And technically a bear market is 20% below the previous high. So once it hits that 20%, we consider it a bear market. And this was the shortest bear market in history, depending on which index you looked at. Some of them were really, really short. But if you would just want to consider a bear fights by swiping down, so it takes its claws and it swipes down, so the market's moving down. And a bull will fight by thrusting its horns upward. So an upward moving market is a bull. So that's why we used the picture of the bear and the bull. Okay, just a little trivia there. But we came into this year with slowing global growth, and we knew that. We knew that we were slowing, but we were still growing in the U.S. and abroad. We also came into this year thinking that overseas markets were much more advantageous to invest in certain areas than the U.S. market potentially, just because they had not fully recovered yet like we had. And then we came into the year and we went into a recession, okay? And what is a recession? You will have economists debate this at length, but essentially most of them believe that a recession is 2 consecutive quarters of decreased production or GDP, okay? So the economy is shrinking for 2 consecutive quarters, that's a recession. And typically, well, no, always, you cannot declare a recession until you go back and look at the numbers. And when we talk about gross domestic product, GDP, you can't officially declare what the GDP was for the country or even the world until usually around, you'll start seeing around January of next year, but by March, that's when most economies' GDPs will be published. So it takes a while to know exactly what it is. So a lot of the data we're looking at are estimates, okay? But when we look at daily U.S. confirmed coronavirus cases, again, this is at the end of June. We won't spend a lot of time on this other than to see that the spike will correlate with where the market was going, okay? You know, more cases, generally the lower the market. And one thing about the market and the economy, the stock market is always ahead of the economy, or at least it should be. So what I mean by that is if we expect the economy to contract or to do poorly, then the stock market is going to anticipate that and go ahead and reflect what those anticipations or those expectations are. If we expect the economy to expand, okay, then the stock market's going to get ahead of that and it's going to forecast it, okay? So when you see a growing market, that's based on expectations. When you see a shrinking market, if you will, or contracting market, that's based on the opposite set of expectations. But the two are definitely correlated. Again, is it a cause and effect? Probably more so in this case because, you know, we came in here into this to this year 2020 on very good financial footing. Especially, you know, although growth was slowing, it was still growing. So we came in very strong, and the catalyst that did it, the coronavirus, which we're not done with yet, that's probably the strongest cause and effect that I can think of in recent recessions. Okay. So here's quarterly GDP growth, and again, this was at the end of 2019, and again, we won't have official GDP numbers until the end of the year or beginning of next year. And this is the Federal Reserve economic data. That's Fred, okay? And the source was 3/31. So you see, they didn't even publish that until March 31st for the previous year. But you can see when you look down here how much had it quarterly GDP. The growth had shrunk. I think it was almost 6% here, maybe about 4.8. And that's shrinkage. That doesn't mean we weren't growing. That's just, the growth had slowed that much. Here's where we'll go ahead and skip to one of the JP Morgan charts. So it may take me just a minute here to find that. Okay. All right, and you should see this JP Morgan chart here now. We're going to go to chart 18, and pardon me for the scroll here. I'll try not to make anybody dizzy. Okay, we're going to be coming back and forth through these charts, okay? But when you look at, depressions, recessions, if you will, and the size of the GDP decrease, and if you think of GDP again, we're just really talking about production. What does a country produce, okay? And you can see the current recession, and this data was as of September 15th, okay? Negative 10.2, okay? Decline in real GDP. Well, if you think about the financial crisis, look, it was only -4. So this is much, much more significant, but again, very short-lived compared to the financial crisis. But look back at the Great Depression. I mean, 26.7, look how huge that was. Post-World War II, negative 12.7, and a lot of little ones, scattered throughout. But if you think about what's a decline in real GDP, right now we think it's about 10.2% decline in gross domestic product, or what we're producing as a country. Okay, and what drives GDP? Really, the biggest driver of GDP is consumer spending. Okay, and I think everyone has already jumped to the conclusion that that is one of the big things that has shrunk our GDP. Okay. Where are people spending money, though? Where have they been spending money? If you see the top line here, mortgage applications. If you know anybody in the mortgage business, they are busy. I don't know the exact numbers, but you can see this is year-to-year percent change, okay? So from 2019 to 2020, at the exact same point in the year, this is the percent change, okay? And you can see consumer debit and credit transactions, okay? Not as low as some others. So people are still using their debit cards, they're using their credit cards, they're using Amazon, right? They're buying online, but obviously they're not in as many stores doing so. Hotel occupancies, no question there. I just tried to book a hotel on an Air Force base in Denver, and they're still not accepting people who are not mission essential. So that's no surprise. Rita's had a lot of trips canceled. I've had a lot of trips canceled. When you look at where we're spending our money, it's in obvious places to most of us. Okay, let me go ahead and jump back to the other chart, the other presentation. Okay, and obviously, if people aren't out spending money, what's happening? Unemployment rate's going up. Okay, so you can see wage growth versus unemployment, and wage growth is the yellow line, and the unemployment, okay, is the green. And then just the recessions are the vertical gray bars. But you can see wage growth, up and down. But you can see right here it was growing, in the latter part of that decade. And right about the time that unemployment spiked, you can see, and it kind of stops here, but wage growth still went up a bit here, okay? But you can see the huge spike in unemployment. And when you look at it here, it says it's almost 16% on this chart as of the end of June. I thought at one point we had topped that, but let's look at the JP Morgan chart and see what JP Morgan numbers are on that. Okay, I thought we had one on wages here and jobs, but I don't see it. When we come across that, I'll share that with you. Maybe it's number 26. Yep, here we go. Again, look where we are today. This is at the end of August 2020. We're at 8.4%. So you see this spike, which the other chart showed. It seems that we've recovered just in percentages about half of that. So we're at 8.4%, okay? And, we've all got our feelings about why people are not coming back to work maybe. Our companies cutting jobs. What we're really seeing is a lot of companies are trying to cut benefits. They're cutting 401k matches. Reducing some vacation time. They're doing a lot of things that that don't result in permanent elimination of jobs, but in some areas they are. The company has to stay open. But we're at about 8.4%. So we're headed the right direction. Okay, I guess that's the story there, is we're really heading the right direction. Okay. But when you talk about unemployment, you talk about GDP, you talk about spending money, then we also care about inflation. Okay. And there are different forms of inflation here, or different definitions. Core versus headline. What we're going to focus on, and the JP Morgan chart will show it better, is really core inflation. When you add in energy and food cost, those are very volatile numbers. Okay, so I don't know why, honestly, food cost is volatile. I mean, I can understand why energy is. I think we all know that. But why is food, part of that we try to strip out to get the most volatile two areas out? I don't have a ready answer for that. If somebody does, just put it in the Q&A and share that with us. But when we strip that out, then the inflation rate becomes a lot steadier. And you can see right now, look back in the early 80s. I was spending money in the early 80s, but I didn't know what inflation was. I was about 6 years old. But I do recall my father and mother-in-law talking about buying a house, and it was not uncommon for people to be between 10 and 20% interest on loans. That sounds crazy today, okay? But inflation is a real danger, and it's a danger for a lot of reasons. But as an investor, obviously inflation is a danger to you, because when your dollar goes much less further down the road, then you need more of those dollars, okay? And deflation is the opposite, where your dollar is just worth more and more. People have argued we're in a deflationary period right now, and you can see where inflation is. It's below the Fed target, okay? And the Fed has always kept about a 2% inflation target, okay? But we're below that, and you can see that 2% line. Now, has the Fed reacted? Not really. They're adjusting their inflation target, okay? So they're not taking action to get inflation back up. And they do that through monetary policy. That's probably a whole other course. But if you want to talk about that, just let me know. But let's go on to another chart from JP Morgan that's going to talk about inflation, number 29 here. Okay. CPI, Consumer Price Index, it's just a measure of inflation, and core CPI. You can see the headline CPI, the 50-year average is 3.9%. Okay. And if you can't see that on here, I'll try to, if I can draw a line around what we're talking about. May or may not work. Yeah, right there. 3.9%. But in this August, it's 1.3. Okay. Far below the headline, the 50-year average. But when you look at July, just a month earlier, it's a little higher. It was 1% in July, okay? And when you look at core, it's 1.7, okay? And then, of course, food and energy here. So the point here is we don't think inflation is going to be a problem in the near term. In the next few years, potentially. And inflation is all part of a normal economic expansion, okay? So we shouldn't be afraid of it, but we definitely have to watch it. All right. Well, I've change modes here. If you want to maybe think about your Q&As or chat, if you got anything to throw in there, go ahead. This probably be a good time to do that, because then we're going to shift off to corporate earnings and profits. All right, and we'll probably just stay on this chart here, or on this set here. Okay, business investment. Okay, our business is investing money in their business, and our people investing money in new businesses. At the end of March, okay, we were about a negative 8.6. This was a trend that had already started. You can see right here in 2019, going back even as early as the middle of 2019 in June, we were starting to see negative growth in business investment. So this is something that was already happening. It's just been exacerbated by the coronavirus. But when you look at certain businesses like Zoom, that we're using Zoom right now, think about all the money that's flowed into Zoom, people that are buying it, corporations that are using it that never considered it before. Think about Amazon, online retailers. Obviously, where there's tragedy, there's opportunity as well. So, but that is something that had already started. And let me see if we do have a good a JP Morgan chart on that. I'm not sure that we do have one that we want to look at right now. But when you talk about consumer spending as part of CPI, and I think we would all agree jokingly, but in all seriousness, that the U.S. government does not operate their balance sheet or their budget like we households do, or if you're a business owner, how you do. Their balance sheets, you could argue, don't matter because they can print money, and that's a whole other discussion. But your household balance sheet absolutely matters, okay? And the point of this chart, and it's a little difficult to understand, is that household balance sheets, how much debt a household has, okay, and the position of strength versus their necessary spending and their discretionary income, we're in a good position, okay? We're in a really good position. You can see the recession starts right here in the middle, okay? And again, that was the 2008. And then look where we are. Again, this is at the end of 2019. This data is a little dated here. But you can see that we're in really good position. That's Canada here. Here's the US. I don't know why there's a different story, so I can't explain that. But you can see what low levels we have here as far as household debt service. Again, think about discretionary income. So we're in a really good position here. Okay. Now, obviously, interest rates are on everybody's mind, right? You've heard even before 2020 and the coronavirus, okay? You heard a lot about interest rates. You've heard a lot about negative rates in Europe. There are many countries that have gone to a negative interest rate. They did that last year. And honestly, if you look back and you Google it, you can go back, I think, as far as 2015, 2016, and start seeing some developed economies were experiencing negative interest rates way back then, but it never became part of the news until 2019. Okay. And really that was about August, September, this time last year. So why did countries, basically they were the central banks, their version of the Federal Reserve. Why did they basically end up with a negative interest rate? Well, primarily they did it to spur growth. Okay. So if money is cheap, interest is low, okay, people are going to spend money and they're going to borrow money. And it really didn't work out that well for them, okay? They thought it would be a real kickstarter to their economies, and it did not do that, all right? So, the question is, will we go to a negative interest rate? Well, let's look at what the Fed has done. And again, we're talking about the Federal Reserve. Okay, they don't directly say, here is the interest rate in the short term or the long term. They can't just declare it. But what they do is through monetary policy, controlling the money supply, and they do control the federal funds rate. And what that is the rate that banks, Federal Reserve banks, and those that participate in the Federal Reserve System, the rate that they can charge each other for short-term loans. Okay, they can control that, and again, it's a very highly correlated, not a direct cause and effect, but very highly correlated relationship there. When the Fed hikes the interest rates, you'll notice if you were buying CDs, your rates went up. Okay, CD rates are an all-time low now. If you're buying a car or a house, that's why so many mortgage applications are out there right now, because interest rates are really low. But when we look at this, what we call tightening cycles, again, these are not recessions, but these are quantitative tightening. So you've heard of QT and QE. Quantitative tightening is where the Federal Reserve is basically restricting the amount of money that is in the system, in the financial system. So if they're tightening the quantity of money, quantitative tightening, okay, then every dollar is worth more. So you've got a higher interest rate. It costs more to borrow those dollars, okay, and you get more if you loan them. And between the tightening cycles is quantitative easing. Okay, it's cheaper. There's a lot of money in the system. We flooded the system with money. It's easy to get, and people start buying. At least that's the idea. You see all those rate hikes, 17 during the financial crisis, leading up to it. And then when a crisis hits, one of the first things the Fed does is they drop interest rates, and they drop them quickly if they have to. You can see how they plummeted there. And that's one time where I think the use of the word plummet is absolutely warranted. You can see how far it fell. What were we, about 5.3 or so, down to almost zero, and it stayed there for a very long time. 2016, we started rising rates again, or raising them, and I'm sure you all saw that, especially if you were looking in the CD market. And then they realized, especially in 2018, we had, except municipal bonds, we had negative returns. I think almost every asset class in the market. The Fed realized that they probably were raising rates at the wrong time and too quickly. Okay, so they stopped, and then this year, obviously, they've come down to near zero. Okay, they're just barely, I think it's 0.15, just barely above zero. Will we go negative? Conventional thinking is no, we will not, because it hasn't worked for those people that have used it to spur the economy, and we don't need to. We do not need to cut rates anymore. So what does the Fed do if they don't cut rates? Okay, how do they get money into the system? What they do is something that they did heavily with the coronavirus, and you can argue that in this situation, the Fed did save the economy. They started buying assets, and that's nothing new. In 2008, they were buying assets. They bought bad mortgages. You saw that, mortgage-backed securities, asset-backed securities. But what they did this time that's different. This is the first time that the Federal Reserve this year bought exchange-traded funds, okay, ETFs. So they were going out there and they were buying index funds in the market, okay? So they own those. Those are on their balance sheet, and they're putting money into the market. We're talking, I'd have to look at the numbers, hundreds of billions of dollars, okay? And they were buying bonds, corporate bonds, investment-grade corporate bonds. They were going out there and buying those things. They were taking them off the banks who held them, off their balance sheets, and giving them money, essentially. That's an easy way to look at it. So they were putting money into the system because we know we don't have any further to go, really, with rate cuts. So would you anticipate a Federal Reserve rate cut? No, I wouldn't. Eventually rates are going to go back up. All right. And let me see if I think there might have been a good JP Morgan chart on that as well. There was that I want to share with you. All right, let's go to chart 33 here. Okay, and this just shows the Fed balance sheet. And if you go to the Federal Reserve website, okay, you can see this. And you can actually look at their daily balance sheet, and it'll show you exactly what they hold. And you can see, again, here's a lot of loans they made. And we did make loans to corporate companies. You all know that. You've seen it in the news in 2020 here, responding to the coronavirus. But in 2008, when things were really starting to get bad, you can see where all of a sudden, starting in 2009, the Fed started buying a lot of U.S. treasuries. Okay, so they actually buy treasuries, government debt. They buy those. Mortgage-backed securities, MBS, and then this other, there's a lot of other things in there that they buy. But you see how the balance sheet of the Federal Reserve just ballooned. Okay, and the discussion in 2019 was, early 2019 especially, and then when the Fed started buying more assets again in about this time last year in September, the discussion was, wait a minute, we were supposed to be shrinking the Federal Reserve balance sheet because we have got to get this off their balance sheet and back out into the market. Long term, we never expected to be here. Well, look where we are now. Okay, this is the line where we actually are, and here's the forecast. And you can go on the Federal Reserve website, and you can see what we have. But if you look down here, this is small print. You may not be able to see it. Sorry, I just didn't highlight. I just wrote over that. If I can get it to go away. Okay, let me get a highlight for you. The current balance sheet, the Federal Reserve, $4.3 trillion in U.S. Treasuries, so it's Treasury bills, okay, and $1.9 trillion in mortgage-backed securities. The end balance forecast is 4.7 and 2.2. All right. So this is certainly of a concern, and especially when you combine this with the fiscal policy, how much money the government's spending. And remember, monetary policy, the control of the money supply, and fiscal policy are two different things, but they work hand in hand. And you'll see even people in the Treasury saying the Federal Reserve has to rescue the economy. When you combine those two factors, yes, that is cause for concern in the future. I think everybody just fundamentally knows that. All right. Okay, so let's look at the equity market. What's all this mean to equities or stocks? All right. So when we talk about stocks and what they're worth, and then each stock that makes up part of the index, if the stock prices are rising, obviously the collection of those prices or the index is rising. Okay, but one of the biggest or the most important ratios that you'll hear is earnings per share or EPS. So how much does a stock earn for every dollar of price? Okay, so is it earning enough to support what you're paying for is essentially it. Okay, and the yellow line here is the S&P 500. Okay, again, it's just one index. It's not the entire market, but it's a good chunk of it. Okay, and the estimated earnings per share here is again, is looking forward. But you can see just graphically how high the S&P 500 has got compared to the earnings per share. Okay, so why is that? Let's go to another JP Morgan chart, and we'll talk about it when we look at it from their perspective. I'm going to have to back way up here, so bear with me. Okay. You can see we're 5% up in the S&P 500 this year. Okay, year to date. That doesn't include today. This chart was produced with yesterday's numbers. And you can see we were at negative 34. So you see how far we've come. Okay. When you think about how the economy has grown or not grown, is the market in sync? Well, you can see March 23rd here. You can see where the S&P 500 was. It was down 33.9%. 34 is, they just round the number there. And then how we've come back. Has the economy really done that? Okay. And if you're wondering down here on the bottom, this is just volatility. Volatility spikes typically when we see that drop in the market. Okay. Has the economy improved that much? The general consensus is no. So why are stocks this high? Well, part of it's driven by tech stocks. Think about Amazon. If anybody on this webinar was smart enough to know that Amazon was going to make a killing in the market and that they were going to replace all the face-to-face mom and pop store shopping, or even not even mom and pop, but just your big box stores. If anybody knew that Amazon would do what it's done, please let us know that, because it caught me by complete surprise. It's so obvious when you look back, but it's never the bus you saw that hit you, right? So we missed it. But there are pockets of the market and the economy that look really, really healthy. Even real estate's coming back quite well. But again, the market is looking ahead in the economy. So the market is believing, at least it's stating that it believes, that the economy is going to continually improve. So when we see coronavirus cases later, if we have a fall spike, or if we have a winter problem combined with the flu, or whatever it may be, you're going to see some volatility, and the market's going to freak out a little bit just in the short term. But what it's telling us today is it believes the economy is improving. Now, again, general consensus is that's going to take about 2 years to get to pre-pandemic levels of, within the economy of growth. We don't know that. That's just an estimation. So, when you think about why stocks are where they are, let's go back and look at earnings per share. Okay. And the light blue here is consensus. So this is, and when we say consensus, these are the people and the companies that feed the data into JP Morgan. And they basically put these charts together with the help of a lot of different partners. And the consensus of the estimates for earnings per share, you can see where we are now, 19, 20, 21. You can see where they expect us to go. Okay. But when you look over here at 2020 earnings growth estimates, okay, as of 9/15, just yesterday, okay, it really depends on what part of the market you're looking at. Energy is still negative 105%, okay. Go over here to tech, 10%. and then there's a wide range in between. What's driving the market? The S&P? Tech. I mean, that's what's been driving it because it's market capitalization weighted. The biggest companies, as far as the value of their outstanding shares in the market, the biggest companies control the market more than the smallest ones do. Okay, so that's what you call market cap or market capitalization weighting. All right, so that's what's driving the economy. Expectations, the coronavirus problem getting better, so we think tech stocks, and then all of the Federal Reserve and U.S. government stimulus. So we talked a lot about the Fed. We didn't talk about fiscal stimulus, the checks, the unemployment, the the cards, the credit cards, or the checks to the taxpayers that have come out. That's all debt that we have to settle later. But that is what has driven this market higher. Okay. All right. So that's the U.S. But what about globally? Okay. Well, they keep underperforming. So a lot of advisors in the last couple of years, if we took the data that we saw and we listened to a lot of our product partners, we probably started weighting international equities heavier than we have before, because it's about 7.3 years on average that the U.S. stocks outperform international stocks. Okay. And I think we're well over 9 now. So just on a timeline, it's about due for that cycle to reverse. And it does. If you look back at history, you can prove that. We've got charts that show that. But essentially what's happened is with the coronavirus, you can see here percentage of the world gross domestic product. So when we think about overseas markets, you can put those in baskets. Okay, you can talk about emerging economies or emerging markets, developed economies. You can separate them geographically if you want, but you can see the big chunk that China has in the world economy. And obviously the coronavirus hit there first and hit there hard. Okay, and as well in emerging markets. All right. So just based on the graphics on this chart, if these got hit pretty hard, you would think that world GDP and thus the world stock market would have decreased as well. Okay. And you can see global manufacturing. This is an index they call the PMI. You can see the coronavirus impact. Obviously, it slowed a lot of things. Apple closed their stores in China. I mean, when's the last time you thought you'd see an Apple store close? Tesla closed their stores. Everybody was shut down from a manufacturing perspective. So that obviously hurt the world GDP and the world markets. Okay. And when you look here at developed and emerging markets, developed is on top. And we just use Europe and Japan as examples. It's not all of them, obviously. China, India, and emerging markets. You can see right here, if this is the baseline, you can see what we're looking at is forward price to earnings, so expectations, okay, relative to the S&P 500. All right, we can see that developed economies, expectations are lower, much lower, and emerging markets were higher, okay? And basically, if they're down here, the further you are down here, they're cheap compared to U.S. stocks, okay? While this chart still shows that they're cheap compared to U.S. stocks, what's happened as a result of the pandemic, and again, it's a lot of cause and effect, but it's not completely that story. Still a lot of just high correlation, is that U.S. markets and the U.S. economy have recovered pretty quickly, but international markets, they were good places to put your money to diversify. They were advantageous. We saw a lot of potential growth there compared to the U.S., but this pandemic has set them back. So, just as we thought they were about to come out of the financial crisis, the lag that they'd had for, a decade or more, they've been set back tremendously compared to the U.S. So you still want to own international, but we're not as excited about it as we were. That doesn't mean go out and sell your international. It's not a recommendation to do that. Okay. All right. So let me see if we've got anything from JP Morgan to share on that. And then we're going to get into the fun stuff. All right. Politics. So we'll just take a quiet poll. Who believes that if Joe Biden is elected president, that the market will tank, as I've heard from some local folks, and who believes that if Donald Trump is elected president, that the rally will continue. I mean, those are typically, depending on who you're talking to, those are two extremes that you hear. But what impact do politics have on the market? I can tell you that directly on the market, the impact is very low. All right. But let's look at consumer confidence. Remember, we said that consumer spending is the largest determining factor of GDP. And GDP, obviously, is a number that tells you how well the economy is doing, and it drives the market. Well, if you are a Republican, okay, here's your consumer confidence. And this is just based on some data and some polls, okay? If you're a Democrat, your consumer confidence is a whole lot lower. If you're independent, you're somewhere in between, all right? Why is that? Because you typically side with the party that you affiliate with. And if a Republican is in office in the presidency, you believe the economy is doing better. Consumer confidence, you're going to go out and you're going to spend money. You're going to take on more debt. If you're a Democrat, you might not think that way. Now, again, this is not an absolute, obviously, because there are people that fall all over the political spectrum here. But this is just a chart to show you how we think, okay, generally. What happens typically during a political cycle, all right? Year 3 of a presidency is a good year typically. And we saw that in 2019, and year 4 isn't so much, okay? This is just data. You can make of it what you'd like. But when you think about following the election, and again, this is indexed to 100, so that's your index line, all right? If the incumbent wins, okay, here's what the market does. If the incumbent loses, here's what the market does, okay? This is just numbers driven. This has nothing to do with political beliefs. It's just a numbers game, okay? Average S&P 500 performance before and after the election. 12 months leading up, 7.6 on average, all right? After, it's typically lower, okay? So that aside, what are the risks? What are the risks to our outlook, all right? First of all, the S&P 500, again, if we're looking at that as a gauge, most of that is driven by big companies, and companies are either spending cash that they have or they're borrowing money. And one of the biggest risks to the economy and the recovery is corporate debt levels, okay? We are at record levels of corporate debt. Now, we're also at record levels of government debt. And both could argue that it's not as big of a deal as it would be if interest rates were high, because they're borrowing at ultra cheap interest rates. So there is something to be said for that. But nevertheless, we are at high levels of corporate debt, okay? Let's look at a JP Morgan chart on this one. Okay, I'll put it in up here. We're going to have to move quite a ways. When you look at U.S. debt to GDP, okay, look at the government debt. This is in relation to GDP right here, 111.1%. Households are doing much better. The American people are managing their money better than the U.S. government. Imagine that. Now, having said that, there was a transfer of money from the government to households. But if you look at non-financial, again, this is taking the banks out of it, if you will. Non-financial corporate debt, 78.3%. You can see how high that was compared to other recessions, okay? It's higher than the previous recession. And when you go back, those are record levels, okay? We can talk about the different ratings, whether it's investment grade or whether it's not, okay? But the fact of the matter is we have a high level of corporate debt. That is of concern. So if you're buying bonds or bond funds, you need to know what they hold, okay? Know how much risk you're taking. Another risk, and we'll just go ahead and stay on the JP Morgan chart here. Let's see if I can find the right one. Is deficit spending. And apparently I wrote down the wrong number here. But the U.S. deficit, we looked at that earlier, projected to reach 3.7 trillion in 2020. Okay, that is the difference between what we have and what we're spending. So we have to borrow it. Okay, 3.7 trillion in 2020, 2.1 trillion they think in 2021. Okay, they project that over the next 10 years, deficits are going to top 4% of GDP, higher than the 50-year average, a chart we looked at earlier. So again, Is that a problem? You could argue that it isn't, but it's definitely a risk that we need to watch. Okay, so as an investor, we're at 12:50 now, so I need to start wrapping this up. As an investor, what do you need to think about? Okay, you need to think about not making some common mistakes. Okay, what are those? Trying to time the market or trying to pick last year's winners or assume that they're going to be this year's winners. Okay, everybody kicks themselves if they weren't in Amazon or Apple or Tesla, right? But that doesn't mean that because those stocks have performed that well that they're going to continue to do that. And Rita's very familiar with this as well. This is called the jelly bean chart. And what it shows you, if you just look at the colors, every color is a different asset class within the market. We're talking about large capitalization stocks, mid capitalization, real estate trusts, small stocks, international, emerging markets, commodities, bonds, different types of bonds, even cash. When you look at just the dispersion here, you can quickly see that it is impossible to figure out year to year what is going to be the biggest earner. Okay. So no matter what the charts say have happened and what we project, history will show us you can't pick the biggest earner. So what do? You diversify. Okay. And that's not only with stocks and bonds and cash and everything else, but you have to diversify within the stock market. Technology, communications, financials, industrials, consumer discretionary and consumer staples. Okay. Why did dividend paying stocks not do what we expected them to do? They were negative for quite a bit longer than growth stocks. And dividend payers are those companies that are typically more mature, more advanced. They're not growing as much, so they're returning money in the form of dividends to their shareholders. Okay. So if you think of things like Procter & Gamble, Johnson & Johnson, Coca-Cola, why did they not perform well in a recession, which they typically do? It's because people couldn't go and buy those in the places that they did. If you think about all the sporting events that were canceled, Coca-Cola took a huge hit. It does not mean that that company is in trouble, but that's why you have to own all of the different sectors, because we could not have predicted that dividend-paying stocks would not do as well in an economic recession, because they have in the past, but it didn't happen this time. Okay. All right. And you can see the chances of positive returns over time if you diversify. And we can talk about what a diversified portfolio may be, but you can see over a 10-year period, if you own only US stocks, 93.7% chance you're going to have positive returns over time. If you have 65 US and international stocks and then 35% in bonds, 100% of the time, over 10 years, they've been positive. Okay. So that's one of the reasons, just to think about that. I guess really the lesson to learn here is expect volatility, expect it to return, expect it to stay with us. Okay. We're going to see that 10% drop about 1.1 times per year. It's just normal. We're going to see 5% down about 3 times a year. We're going to see a bear market about every 3 years. That's a normal part of investing. But if you don't react to those and you just make sure that you're positioned according to your needs and your risk tolerance, then you're going to be fine. All right, Sandy, I think I'm really at the end of my time. I could talk for about another 30 minutes, but let's throw some Q&A and chats out there. Is there anything that we need to discuss?
I haven't seen anything right now. If you do have questions, please share those. But Mark, while we're waiting to see if anyone's going to send us a question, for clients now during this market and during COVID, what's some good advice that you could give someone that either they've been laid off and
right,
or their position has been dissolved and they've got investment to do right now with their money? What kind of advice could you give someone right now?
Okay. Well, I think our advice probably has not changed at all from even when we were in a bull market. Okay. Now, that's assuming that you're not in a situation where you've lost your business or you're going to. Okay. Or you're not in a situation where you've really lost your income. Okay. Because those are what we call planning for the unexpected. And if you had not planned for that, then obviously you need to look at your assets and figure out what your priorities are going forward. There's no shame in saying, hey, my priorities have changed. Therefore, I have to use my money differently than I did before. I mean, that's just reality. That's life. We all go through that at one point or another. But as far as diversifying your portfolio, making sure that your investments match your goals, making sure they match your timeline, making sure they match your risk tolerance, those are things you hear from an advisor. And it's not that we don't have anything better to tell you, but those are things that just work, and they work in all markets. Okay. So in March and April, I guarantee Rita had the same thing happen to her that I did. We have hopefully a short list of clients that were absolutely convinced I'm going to lose all my money. And what we had to do is refocus them on, okay, what are your goals? What are your timelines? How much risk are you willing to take? Because what you're seeing right now is something that you said you were willing to go through, and you understood it and you accepted it. But when it happens, there's a difference between your tolerance and your composure, right? We can all say, well, I've got a high tolerance for pain, but then, you get a splinter and you're crying about it, or you stub your toe. That's your composure, right? And a lot of times it's different. But just recentering on why you're invested and what your money is to do for you, it's the same thing whether it's in a bull market, a bear market, or in between, okay? Having said that, if you don't know that, if you don't have a very scripted plan that you know what you own, you know why you own it, one of the biggest dangers you can have, there's a great strength to having enough cash on reserve. One of the biggest dangers to you is having too much in cash. You will fall behind and lose money every single year if you have too much of your money sitting in cash. And that's what a lot of people do. A lot of people go buy gold, and I'm not saying don't go buy gold, but a lot of folks will say, oh, I'm going to go buy gold, physical gold, because if the economy collapses, it's going to be worth something. Well, if the whole U.S. financial system collapses, I hope you can eat the gold, because you're going to need to have food. You're going to need to have water. You're going to need to have shelter. And nobody's going to take big blocks of gold and haul them around because you don't want to anymore, right? So just to be rational about those types of things, I think is really the point. And to have a discussion with somebody, whether it's me, whether it's Rita, whether it's a financial advisor that you already have, or just somebody, just have the discussion. And when you do that, I think you'll quit worrying so much about what the market's doing, really.
We do have a question. Ron Dickinson
Yes.
wants to know, what are your thoughts regarding Buffett taking a major position in Barrick Gold?
So, Ron, I have to tell you, I do not have an answer for that because I have not read that article. I will tell you just generally, though, obviously, well, I can't say obviously. There may be somebody out there that says Warren Buffett is not the greatest investor of all time. I think generally people think he is. However, that does not mean that we should go take a major position in something like that, because Warren Buffett is running Berkshire Hathaway. He's running a company whose needs and ambitions are completely different from any of us as individuals or business owners. So just because he's taken a major position in gold doesn't mean that we should. Now, having said that, don't think that I'm anti-gold, anti-silver, anti-precious metals, or whatever it may be, because those do have a part in your portfolio. If you own mutual funds, I guarantee those mutual fund managers have some type of allocation to those types of things. But I don't have a direct answer for you, Ron. But if you want to shoot me an email, I'll look that up and give you my thoughts on it for sure.
Great. I don't see any other questions right now, but Mark, I want to thank you for taking the time out of your busy schedule to share your expertise with us today. And also, I want to thank each one of our guests for taking the time out of your schedules to join us. It's, our goal with this whole program is to share tips and resources to help our business communities in Virginia and surrounding areas grow. So just wanted to let you know that this session was recorded today. And what I will do is Mark was nice enough to send me his some slides and so forth. So I will send those to you, as well as a link that you can have access to today's session. There may be something else you want. Now, what was it Mark said? Or better yet, you may want to share that with someone that could find value in the presentation. And Mark, we had someone want your contact information, and I can share that on the follow-up email with his slides a little later today. So I'll send that to you. Just want
Absolutely. You can find me on, I was
Go
just
ahead.
going to say, you can find me on LinkedIn as well. LinkedIn, Facebook, the internet. But yeah, I appreciate that.
Yeah, great. This also, we will be uploading this session to the Virginia Highlands Small Business Incubators Facebook page and our YouTube channel called New Knowledge, where you can find hundreds of professional development workshop videos that we've done over the years. Really, we started videoing live streaming, I guess, in 2015. So we've got a good archive of training sessions on there that's available for you. I hope you'll join us every other week that we've done this. We've got a great schedule of presenters and topics lined up through June of 2019. So don't make this your only time. I hope you'll make plans, and if you can go to the incubators Facebook page, the chambers, or you can go to vastartup.org website and find a list of upcoming events. And I can also share the flyer with you after this. So, Mark, again, I thank you and wish everyone a great afternoon. And I will see you in a couple weeks. Thanks,
You're welcome.
everybody.
Take
Bye-bye.
care.